The study says that analysts are, quoting here, unable or unwilling to accurately predict earnings. Why not?
So basically the problem here is the accuracy and the quality of the financial reports being handed down by the companies. The companies themselves are not giving very accurate guidance, and really the analysts are only doing what they can with what they're given. There's also this idea that, right after all of those measures were passed from 2000 to 2003, people were on their best behavior in 2004 and 2005 when the microscope was on them, and then once they kind of felt like the lens had shifted, they kind of slunk back into their old ways, and the quality started to suffer. And yeah, we've seen a decline in accuracy actually since 2000.
Wow, the watchdog's off the beat. It's more like mom and dad aren't home, so let's go back to our bad ways, it seems.
Exactly.
The test used in the study, they didn't determine a cause, but the authors did speculate on what's going on. What did they come up with?
Yeah, so they didn't run anything to show why exactly this has been, but they inferred that it's really just starting with the companies and the quality of the information that they're giving to the analysts. And so I think they were planning on doing a little more on that in the future, but for now they've really just concluded that analyst forecasts are less accurate than they were before all the measures passed to make them better.
Okay, sounds like what we're talking about here is due diligence, at least on the company's part, the C-suite's part. Is there anything that can compel companies at this time to release more detailed reports? Well,
I think one of the big issues right now is the lack of clarity in the guidance that they give. They set the bar low, so it's an easier hurdle to jump over before they announce earnings, and that may be playing into this idea that they're not giving as good information because maybe they're withholding something, or maybe they're just not being as transparent as they should be, and which is kind of ironic because that was the whole point of Sarbanes-Oxley was to solidify a set criteria for financial and accounting data.
Joe, about 30 seconds. What impact is this having on the market?
What this is having on the market is it's basically just resulting in analysts throwing darts at a dartboard. You can't really trust exactly what they're saying all the time. If their accuracy is waning, and it's gotten worse over the years, it's a little bit more difficult to look at analysts and say, I think I know what's going on with the company by reading their research.